Hi, I'm Stacy Francis, President and CEO of Francis Financial. Each month, we're going to be coming to you to share market trends that impact your portfolio and investing strategies. We'll be talking about the pieces that you need to know about, and most importantly, what we're doing to plan, grow, and protect your portfolio and your overall wealth. You'll receive these videos straight to your inbox, and typically they're going to be about 3 to 5 minutes. So you can listen to them on the way to a meeting, in your car. Don't look at the visuals if you're looking in the car, or just even out on a jog. If you have any questions ever, know that we have an open door policy, and we love to talk about not only you, but of course, what's going on in the market. So I wanted to start off with a 2021 review. And what this chart shows you, it shows you the overall markets and how they performed. This is actually global equity. So it includes both US stocks as well as international. And the biggest piece to take away is that, wow, it was a pretty darn good year. In fact, they increased 18.54%. In addition to so much market news, there was a lot of news in the headlines. We had the major market drivers, Biden taking office as our 46th president. We also saw huge market news as inflation increased to record levels. And know that we're going to be talking more about inflation in a couple more slides because it is an important topic and there are key pieces of information you need to know. Other areas that really rock the market were essentially hitting that high midway through the year, and part of that was seeing consumers get to the stores again. In fact, we saw global durable goods go up significantly. People buying cars. In fact, wait lists for months for certain models. Used cars even sometimes harder to find. And so consumers going back, showing that optimism overall. And then at the very end, seeing that while it is very clear that it was quite a choppy year, a lot of volatility, even more so in this last quarter, overall was a really positive year. And, that positivity was in quite a few different asset classes, creating a little bit of a roller coaster, I will say. But the asset classes that did the best, you can see very clearly the S&P 500 was the real horse race winner here with a 26.9% return, almost 27%. And small company stocks did well. Their returns were about half of that. Small company stocks in that Russell 2000 were about 13.7%, so almost a 14% return. Definitely nothing to sneeze at. International stocks, so developed international stocks, such as those from Canada, the UK, Germany, they did quite well too. So they had almost an 8% return. Well, who were the laggers? The laggers here that I highlighted in red to kind of bring their attention to corporate bonds were, essentially flat. Treasuries were pretty much flat, and those that started to post some negatives, those gold bugs, those of you that love gold, well, you weren't so happy in 2021, nor were you happy. You were really unhappy with silver. Silver was almost a 12% loss, which is one of the bigger losses we've ever seen from silver. And the MSI emerging markets. Emerging markets didn't do so well. And that, to be honest, is not something that we're surprised by. Emerging markets over the last several years have truly been the high flyers. And so the fact that we've seen a little bit of a pullback is not something that really surprises us. Actually, doesn't necessarily concern us either. But what it did tell us overall, what this story tells us, is that those with diversified portfolios like you fared the best because you had wonderful broad exposure to some of the top performers of the year, and your other exposure to bonds and emerging markets for most people, relatively smaller. So our clients were very happy last year. And what does this mean going forward? Well, there are some pieces that you need to know. And the first one I talked about was just a few minutes ago, about inflation. There's a lot of concern about inflation. It's been especially rapid in certain areas such as food and energy. And we're seeing that the US Consumer Price Index actually jumped 6.8% from a year earlier levels in November. It's a rise that we actually haven't seen to that extent in about 4 decades. So, with that understandably being concerning, we went back quite a while. We went all the way back to look at how the US stock market has performed versus inflation all the way back to 1991. And how you read this, these red dots that you see here are the inflation, that percentage of inflation for that year. And then the teal shows you how the S&P 500 performed. And one of the concerns people have is that rising prices is going to, make it harder to reach those financial goals. But knock on wood, what we are seeing and what looking backwards tells us is that overall, the US stock market has really trounced those inflation numbers, and that the portfolios have grown significantly more than inflation. So, there's hopefully a lot of good news you can take with this to make sure that and know that your portfolio is keeping up and in many cases outperforming inflation, putting you financially ahead. Now, the second concern that a lot of people have, and if you turn on CNBC, Jim Cramer talks about this, several others, um, is the concern that the good days are over. Well, we wanted to take a look and see, what happens after a market high. And we saw that the S&P 500 notched very high, reaching all-time records this year. And one of the biggest concerns people have is a tendency to believe that reaching that high signals that there's going to be a stock drop, that stocks are overvalued. So we went ahead and went all the way back to 1926 to take a look to see, well, is this true? And we compared two time periods. We compared the time period after a market high compared to just average performance. And we looked at how the stock market performed 1 year after, 3 years after, and then also 5 years after. Um, what hopefully will give you that you can take heart is that what we saw is that in all of these areas, both the 1, the 3, and the 5 year, that the performance from a market high to just a regular time, the returns, you can see this, are pretty darn similar. If you take a look here, the 1 year return after a high was about 14% versus in normal times it was 12%. When we look at what was the annual return after 5 years from a market high, it was 9.9% versus 10.2%. So very similar. A lot of investors are surprised by this. So don't let that factor of hitting a market high be the end all be all, because it's not. It's not for us, and it shouldn't be for you. There are so many factors that go into how a diversified, robust portfolio are created. And the price of stocks versus their earnings, well, it's one factor out of about 100. There are so many others, including the most important is where you are in your life cycle, how much your portfolio needs to earn for you, and of course, what your risk tolerance is, what allows you to sleep at night. And that's what I would love to end with, because ultimately, working with a financial advisor is meant to help you sleep at night. And that's what we'd love to do. We are Francis Financial. We are here for you to help manage your entire financial life, helping you plan, grow, and protect your wealth. Thank you for joining in. I'll see you next month, as well as the rest of our team joining in to bring important market trends, insights to you each month. Thank you.